Hello and welcome to my presentation, How to Survive the Coming Crash, 2015 to 2016. The information provided is for informational purposes only and is not intended to provide financial, legal, accounting, or tax advice and should not be relied upon in that regard. For proprietary and confidentiality reasons, no recordings or copies are allowed. By remaining here and continuing, you have agreed to these terms. Welcome and thank you for your cooperation. This presentation is based on mathematical facts. The data is from the S&P 500 and the USDebtClock.org and other trusted reports and information from the internet. You decide for yourself if this is for you. I've been collecting the daily data from the S&P 500 every year since 2004. I have a database now that has every trading day from February 3rd, 1950 to today. This is the data I use for my charts and evaluations. Let's see what that looks like. I use the S&P 500 because it has 500 U.S. stocks, 100 industries, and covers 70% of the U.S. economy. It has every trading day. It has the open, the high, the low, and the close. Old data is just the raw data, no fees or adjustments. Now let's look at the data in a chart. In this chart, you'll see on this side from 1950 to 1981, and on this side we have 1982 to 2015. We have the first year or 1 year returns here, and across the top we have 3, 5, 10, 15, 20, 25, and 30 year cycles annualized rate of returns. The gray area here is the 10-year returns, annualized rate of return after 10 years of investing. This is what I use to evaluate investments. Here you see that the gray areas show the negative corrections for each of the years where there was a negative return. Now let's look at that data a little closer. Over here you see that we had double-digit negative returns every 3 to 4 years. Here in 1973-74 was a crash, which was a minus 47% crash over a 2-year period. Over here we had 18 years, 1982 to 1999, with only 2 small corrections. Going on at the same time, the Great Bubble, 15 years of double-digit 10-year returns from 1987 to 2001. Here was the 2000-2002 crash, minus 46.5% over a 3-year period. During this 1987 to 2004 period, it was the largest economic boom in U.S. history. The baby boomers were working, the internet boom was going on, stock options were being offered to almost everybody that worked in the semiconductors. 1980, they introduced the 401k, which brought millions and millions of dollars into the stock market. The dot-coms were running amok. High-tech immigration was going on. And with everybody having so much money, the housing market was bid up and created a housing market boom. This all culminated in the largest bubble in U.S. history. This, of course, led to the largest collapse in U.S. history, a minus 38.5% drop in just 1 year. Now, if we look over here, we have the 10-year annualized returns. 3 of the 10-year returns lost money. This is after the great boom where you couldn't lose money. Everybody was making money. Average 10-year returns, 7.23%. When adjusted for the June 2015 numbers, it came down to 6.92%. Now, if we go back over here before the great boom, 4 of the 10 returns lost money. After 10-year return, average was 3.7%. Now, if we look at here after the boom and here before the boom, we find out that it's basically the same. This is why before the boom, The first question any advisor asked you when you wanted to invest in the stock market was the number one rule. Don't invest while you can't afford to lose. So why does everyone have their life savings in here? It baffles the imagination. Now let's look at the data in another chart. This is called a mountain chart. You see here in 1973-74, the correction, minus 4%. If you had a $13,600 account, you saw it drop to about $7,900. Over here, the 2002 to 2002 correction was minus 46%. If you had about $170,000 in the account, you saw it drop to about $100,000. 2008 collapsed, minus 38%. Say a $170,000 account dropped down to about $104,000. Now here we are in 2015. The account's probably around $238,000. What do we think that this is going to do? What's your guess? We've all heard of the bulls and the bears. They adjust their strategies according to whether they're bearish on a market thinking it's going down or bullish thinking it's going to go up. Because they adjust their strategies, about 67% of the time, the bulls and bears make money. On the other hand, we have the pigs. They try to eke out every single penny. They always wait for the last second. Don't really have much of a strategy. Pigs just get slaughtered. Please, let's not be a pig. Other factors driving market risk in the economy. Uncle Sam, you all met him probably. His hand's usually out. Why? Because when you earn anything, they tax it. When you spend anything, they tax it. When you save it, they tax it. When you own it, they tax it. And when you die, they tax it one last time. Or actually two, when it goes to your beneficiaries. What do you think taxes are going to be going? Since they've been at all-time low rates and they're starting to creep up now, they're probably going to continue. Let's look at some historical tax rates. Back in 1945, if you made over $200,000, you had to pay 94 cents on a dollar. 94% federal tax rate for every dollar over 200,000. Unbelievable, but true. At the same time in 1945, the capital gains was at 25%. Now in 2015, if you make over $465,000, for every dollar over that, they're going to take 39.6%. We had been going down fighting this crazy tax stuff for a long time. Got down to about 28%, and now it's going right back up. We don't seem to learn from our mistakes. Over here in capital gains 2015, we're up to 20% from 15%. What the heck is happening? Corporate rates in 2015, 35%. Now let's look at workforce participation rate. This is a chart right down in here. It's a major player in the economy as well. From 1986 to 2008, 22 years, the participation rate has been from 65 to 66%, with a peak in 1997 of 67%, which came to a 1.8% swing. But look what happened here, 2008 to 2014. 6 years drop, 3.1%, down to 62.88. The workforce participation rate is all civilian workers age 16 and above. It's now been the worst it's been in 38 years since 1977 was at 62%. The unemployment rate is a percentage of the work participation rate. And I don't really like to use this red line because it's manipulated so much. Let me show you an example. Actual employment. Now these represent 4-year cycles of presidentials. Here in this 4-year cycle, 22.2 million people were unemployed. Actual numbers. Over here on the official side, that same 4-year cycle, 12 million people were unemployed. The official side seems to be about half of what the actual unemployment is. So why would you even look at this number? The number one factor driving market risk. Does anybody know what that might be? I believe it's our aging population, the baby boomers. As of 2009, 10,000 people a day are turning 65. 10,000 times 365 equals 3.6 million people per year retiring, turning 65. The presidential cycle from 2004 to 2008 showed 2.8 million people retired. The 2008 to 2012 presidential cycle, 12.2 million people have retired. This is what our problem is right now. Our aging population. Let's look at this data. When you look at the news media, listen to all this stuff, they cover revenue, budget, deficit, and debt to keep us preoccupied on that. The data I'm going to show you covers from 1996, from 2012, comes from the usdebtclock.org. This last cycle is the 2012 to 2016 cycle, is what we're in now. But if we look back here to the 2004-2008 cycle, we had 2.8 million people retired. This is the 2002 to 2012 cycle. We had 12.2 million people retired. That's 84% of the 14.6 million people turning 65. Does everybody follow me on this? This has never happened before, and this is going to go on for the next 20 years probably. That was 4.3 times more than the 4-year cycle before. This is a huge, huge problem. What don't they talk about? What are they hiding? What cans are being kicked down the street? Let's look again at this data. Revenue of May 2015, as of May 2015. See that T? Trillion dollars. $3.1 trillion. Spending, $3.6 trillion. Deficit, $494 billion. Debt as of May 2015, $18.2 trillion. This is what the Daily News covers. Let's look over here. Our gross domestic product. Don't much hear about that. $17.7 trillion. That means that in our debt of 18.2, we owe more than we make as a country. Look at the total U.S. assets. This is all the assets that's owned by corporate and private America. Everything is totaling $116 trillion as of May 2015. Look at where Social Security used to be at. Look at where it's now. This is Medicare. See where it used to be? Look at where it is now. It's off this chart in 2012. Because look at what happened here in this cycle we're in. All of a sudden, it's down here at 27. What happened? I'll tell you in a few seconds. Medications. This is the first cycle that they were signed into law, and they're already off the charts. And look at Social Security, Medicare, and medications combined was down here, and now they're off the charts. Uh-oh. Do we really want to see what's up there? For those of you who have a weak heart, stop the video now. For those of you who have a strong heart and are really curious and are in good health, let's proceed. This is the Daily News. Look at this. I want to show you something. Social Security benefits, Medicare, and drugs combined $122 trillion as of December 2012. Look at over here. The total U.S. assets at that time was $92.9 trillion. That means that the entire wealth of the country, everything we own, was $19 trillion less than our liabilities. But what happened here in the cycle we're in? $116 trillion in U.S. assets has grown to, which is good. But how did this happen? The Social Security benefit, it dropped to 96. Now we're $19 trillion more than our unfunded liabilities. This is what's happened. Notice the Medicare here. After 2012, the new healthcare laws transferred a lot of the federal Medicare liability to the state's Medicaid programs. A special note for those of you who don't know, the Medicaid, or here in California, Medi-Cal, is the citizen state bailout. If the state takes over your care, any money that you use after 85 in current law, they go after your estate when you pass away to pay it back. You owe this money back. And now our Medicare system, our medical system has moved everybody into Medicaid. A lot of people into Medicaid. This is unfunded liabilities. Yikes! Our grandkids, our great grandkids are all going to have to deal with this and pay for it.
Now let's look at how we survive all of this. When you look back in history, what has always survived the world wars and economic collapses of governments and countries? Do you know? Our grandkids have to know. Gold and insurance. That has always survived. Since the beginning of civilization, the two things that have always retained value and protected assets has been gold and insurance.
Remember this mountain chart? Remember 2015? It's been 7 years since the last correction. What do you think it's going to go? Really, where do you think it's going to go? It's going to happen, but when? It's got to correct. Sometime between this year and 2017, it's got to do something big. Let's look at U.S. home sales, Western region. Look at what's been happening here. 1981 correction, 1990 correction. This is the 2000 correction. Look at that big drop. And where are we at now? Another big bubble in 2014, 7 years from the last one. What do you think this is going to do? Does anybody see that we're repeating history? Gold and insurance. Let's talk a little bit now about gold.
Okay, now let's talk a little bit about gold and its history. If you remember right now, gold is at an all-time high. If you already have it, that's great. But what if you didn't get it? Well, let's look at some things. Remember, back in 1933, the government took gold away. On or before May 1st, 1933, all gold coin, gold bullion, and gold certificates had to be turned into the federal government under executive order of Franklin Delano Roosevelt. This was also under penalty of a $10,000 fine or 10 years imprisonment or both. If they did it then, they can take it again. Now let's look a little bit at a history. 99 years, from 1833 to 1932, gold was only at about $20 an ounce. For the next 37 years, from 1933 to 1970, gold was only between $26 and $35 an ounce. Now, it went over $100 an ounce back in 75, 76. Then it spiked up in 1980 to $850 an ounce when Jimmy Carter places a grain embargo on Russia, and we thought World War III was going to start. After that, it settled in for 24 years, from 1981 to 2005, between $300 and $460 an ounce. This is when people started putting in their portfolios 5 or 10% to keep a base in your portfolio because it seemed to be maintaining its value. We didn't have a big spike again until 2012, when it shot up to $1,781 an ounce during the Benghazi attack. Again, what happened here? We thought all heck was going to be breaking loose. Now, over the next 3 years, back to August 12th of 2015, it was at $1,188 an ounce. That's a 33% drop over those 3 years. So, if the reason you're planning to buy gold now is because you think we're going into a World War III or a major collapse or calamity, my personal recommendation, and this is up to you to decide for yourself, is gold chain. The government doesn't know about our jewelry, how much we have, how much we bought, okay? So to me, if you think it's calamity and you're going to have gold to spend, gold chain. I recommend a gold chain that has these predetermined, pre-measured links on it. Why? Because you can cut the links and spend them just as coin. You want to make sure that it is stamped. I would recommend 14 karat to 24 karat. The closer to 24 karat, the better. It's easier to cut. You keep the chain intact and you cut away the links the furthest from the stamp. That way people can't argue with you that you have real gold, what it's stamped. And you'll know how much it weighs, so you know what the value is, so you can't be cheated. That's my personal recommendation. Now, remember this gentleman here? Warren Buffett. He had two major rules about investing. Rule number one was never lose money. Rule number two was never forget about rule number one. That's why we're talking about asset insurance.
Golden insurance, right? On the insurance side, we have what's called a fixed index annuity. They were created in 1995, and in this 20 years since they've been created, there have been no market losses, not one dime. Let's look at the Wharton report. Professor Babel was interviewed in the Annuity Digest, and he said about the report that there's been a lot of misinformation about fixed index annuities in the press. In this in-depth study that they did, it took 2 years. They had 6 PhD financial economists and a pair of very well-known senior actuaries. They used actual products, and they have performed better than many alternative investment classes, which were corporate and government bonds, equity funds, and money markets in any combination. Further in the report, he said, FIAs have historically, when adjusted for risk, they have dominated the alternatives. The returns of fixed index annuities outperform the alternatives over the lifetime of their existence for every year that they have been issued. The actual report used client fixed index annuity statements as their data. No speculation here, actual data. For moderate and strongly risk-averse individuals, the fixed index annuity is judged superior in performance to various combinations of stocks and bonds. Actual results, remember, real, not hypothetical. Most comprehensive data ever assembled for actual fixed index annuity performance to date, based on copies of actual customer statements. This is real world data. Let's look at that data. This is 5-year periods of the S&P 500. This is the returns of the S&P 500. This is the average fixed index annuity return. And over here is the return range. Notice over here that there are no negative returns. Why? Because no one has ever lost money to market volatility in a fixed index annuity. This first 5-year cycle, the S&P returned 9.3%. The fixed index annuities 9.1. The range was 7.8 to 12%. Down here, this 5-year period, 13% returned by the S&P, 6% returned by the FIAs, 3% to 8% was the returns. Over here, you have 5-year periods where people lost money in the S&P. Got me? They lost money. Over here, nobody lost money. And the returns were from 3 to 8% over those periods when people lost money. Fixed index annuities are a solution for some of us. And most of us probably need some of our assets protected here. Index annuities results best at the S&P 500 alone 67% of the time. So if you're in the S&P, the fixed index annuities beat you 67% of the time. A 50-50 mix of 1-year treasuries, 79% of the time. This is trying to represent a diversified portfolio. FIAs have never lost money to market volatility. Index annuities results best in S&P 500 alone 67% of the time, and a 50-50 mix of 1-year treasuries 79% of the time. Fixed index annuities outperform the alternatives over the lifetime of their existence since 1995 for every year they have been in existence. So if you can't afford another 2008, and who can, you need to look at moving a portion of your assets to a short-term fixed index annuity at least until the next crash is over. Then move it back into the markets if that's what you still want. IRAs can be moved without being taxed. At least you have a safe haven that has never lost a dime in 20 years to market volatility and has historically bested the S&P 500 67 to 79% of the time. You insure your house, your car, your life. Why not your assets? The end, or is it? My name is Victor Lloyd Burgess. Call me. I can help you survive this.